Welcome back. You're watching The Money Show on ET Now. Well, ICICI Prudential is launching a flexicap fund. This is a very interesting category indeed because it gives the fund manager flexibility to choose from whatever market capitalization that they want. They can pick a stock from either large cap or mid cap or small cap without any restrictions on how much of each market cap can they own. So lots of flexibility, bottom-up and top-up approach is what the fund manager can use for stock selection. Let's understand a bit more about this fund offering, which, by the way, is open for subscription for you, the investors, till the 12th of July. That's 10 days more. Chintan Hariya joins us now on the show. He's the head of products and strategy with ICICI Prudential Mutual Fund. Chintan, thank you so much for taking our time and joining us. So just start off by, just introducing this flexicap fund for us first.
Yeah, sure. So we are at an interesting juncture in the markets wherein we are seeing a broad basing of markets. We are seeing global liquidity ensuring inflationary help in the equity markets in terms of various sectors doing well. And in such times, typically over the next 2 to 3 years, we are expecting earnings growth in India to be better than what they have been in the last 4 to 5 years. So with nominal GDP growth improving and investors having these two questions, right? Where to invest their money and how to invest their money, we felt that the ICICI Prudential FlexiCap NFO is an opportune time for investors to look at it. The fund is very simple in its construct. It is the most unrestrained, or it's like the unconstrained strategy wherein the fund manager will invest within large cap, mid cap, small cap across sectors and curate a portfolio which we believe for the next 3 to 5 years can generate good risk adjusted returns for the investor.
So what sort of advantage do you get when you have the freedom to invest across market capitalizations, without having to worry about capping and putting a certain amount only in large caps, certain in mid caps, etc.? What sort of advantage does it give you?
Yeah, so the flexibility has to be utilized. That is the most important thing. In other words, we have to move between mid caps, small caps, and large caps as and when the markets give opportunities, and that's where this fund can potentially better in terms of risk-reward trade-off than a pure small cap, mid cap, or a large cap fund. However, of course, each investor can have multiple ways to invest in markets, and each fund has its own unique space. That's where the advisor will come in, and the advisor can guide you based on your overall allocation. But from a flexicap perspective, what we are bringing to the table is a market cap model-based approach towards deciding how much large cap, mid cap, and small cap should be there in each portfolio now in the fund. And if we see as things stand today, last 1 year in terms of performance for mid cap, small cap has been good, better than the large caps, and hence the valuation discounts for mid cap, small cap have come down. So gradually the model would have told us to reduce mid cap, small cap allocation in the last 1 year, and in the future as well through this mode of increasing and decreasing mid cap, small cap based on the model. We endeavor to basically give an experience to the investor which will help them participate in the right proportion across large cap, mid cap, small cap over a long period of time through the application of this market cap based model.
So across different market cycles and volatility, how will, how do we expect the fund to perform? Do you think it has the power to stay a bit more resilient comparatively?
Sure. So the expectation that we have is that, for example, in the past, we've seen where 2014-15 to 2017 was a good period for mid-cap, small caps. In fact, 2017 was a year in which small caps and mid-caps became much more expensive than their long-term average, and it would have made sense to reduce equity exposure in the mid-cap, small-cap space. And that's exactly what probably the FlexiCap model would have told us, and that we would replicate in the FlexiCap fund. Reduce mid-cap, small-cap at a time in 2017 when the valuations had become too expensive. What it would help achieve is that the subsequent 2018, 19, 20 correction, which happened in the mid and small-cap space, the fund would have benefited out of not being in mid and small cap in a major way, at the same time being able to buy on the way down because the model would have incrementally told us keep adding to mid and small cap as they kept on becoming cheaper. So through this allocation mechanism and the past experiences that we've seen, we believe that the investor will ultimately benefit if we are able to buy mid and small caps when they are cheap and reduce them as they become more expensive, and continue this process over a longer period of time, with the objective of ensuring investors do make, with the right allocation in large, mid and small cap, make better risk-adjusted returns in the flexicap fund.
So now that you have market cap freedom, at least, Chintan, what would be the filters you'll put in place, the parameters for selecting stocks for the fund?
Sure. So once it is decided that how much large cap, mid cap, small cap is done, then the next question comes in that which sectors to invest in and which stocks. And that's where the flexicap again helps, because the sectoral allocation will be well diversified across all the sectors which we see potential in. And within them, the stock selection would be a mix of those stocks in which 3 to 5 year earnings visibility, growth visibility is there. The management quality is good. The stakeholders are being taken care of. All the stakeholders are being taken care of by the management. And also, if we look from an overall perspective, the underlying stocks should have a good balance sheet strength as well. So I think a combination of good balance sheet strength, 3 to 5 year growth visibility, and the management, which is basically taking care of all stakeholders, would mean a well curated portfolio of 35 to 40 stocks across the various sectors, across many sectors which are there in the market, which will help achieve the next 3 to 5 years participation in the markets in India. Because Indian markets are going to be broad-based, we are seeing a broad basing of market, which is what will get reflected through this bottom-up stock selection process across sectors in the flexicap fund.
Chintan, let's talk about now suitability of this fund. You know, a lot of retail investors are listening to you, and let's talk about what should be the investor's time horizon and risk appetite before they consider subscribing for this NFO.
Yeah, so as we know, the flexicap category is a very large category, and for all investors who want to allocate in equity markets, this is a category which should be there as part of their portfolio for the longest period of time, 3 years, 5 years, 10 years, because in inflationary environment in which we are in, where equities markets tend to do reasonably better, it would make sense to have an allocation to equities. Indians are anyways underinvested in equities. So I think from a suitability perspective, those investors who are looking to invest in the markets but are fearful that, okay, my current market levels are too high, we are also going to stagger the investments in the NFO. So we will not immediately invest, but stagger it over a bit of time and try and get the benefit of market volatility at least over the next few months, and curate a portfolio which ultimately will help investors. So I think all investors, it will suit well those who have risk appetite and want to participate in equities. Indian allocation towards equities is as it is too low. And at today's juncture, we believe that with the broad basing of markets and many sectors and stocks also opening up, a flexicap fund will suit investors very well. And those who are looking to move away from pure, let's say, fixed income, or move away from 100% fixed income to some equity, the flexicap fund is very well suited for them to start their journey in terms of the equity markets and remain invested, more importantly, for 3, 5, 10 years. If you have a less than 3 year horizon, then equities as an asset class you should not be investing in. But if you have a more than 3 year horizon, clearly the flexicap fund will fit in all investors, the first time investors as well as those investors who already have a portfolio and are looking to increase their equity allocation.
Chintan, thank you so much for taking our time and joining us on the show, introducing your NFO as well, the new fund offering, that's ICICI Prudential Flexi-Cap Fund. Viewers, of course, have the opportunity to subscribe for the very first time. It's almost like an IPO version of, the mutual fund version of an IPO. The NFO is open till the 12th of July.